my friends were like, why is it that they can do that? Why aren't you guys coming back and having a rebuttal to all this information? And the answer is that Primerica is a very, very compliant company. They do not allow us to go and promote products online. They don't allow us to mention the company name, right? And they really don't like when not that I ever wanted to do this, but a lot of people do, and it does work, is promote our lifestyle and attach it to our business. All of these things are really uncompliant from a regulatory standpoint, and the government comes after people like this. The Federal Trade Commission will come after people like this. So in my opinion, a lot of this, the way things work in the world now is you can now stay ahead of the government. The government is so slow, and the people there are just, they've kind of aged out to the current culture and technology. And so it takes a long time for the government to understand what's happening, right? The senators are not on TikTok. They have no idea. So the information can spread, and it'll take a long time for them to go back and be like, hey, these are all violations. And eventually that stuff will be taken off. But right now, the other companies allow their agents to do that. We're not allowed to do that. And so you're going to get a lot of calls. You're going to get a lot of questions. You're going to get a lot of people wanting to, inquire about this. And so my training today is to really help you understand. It's not going to happen just, over the course of one training, right? We have to constantly hammer this concept in that it is never appropriate to have cash value. There's no advantage to having cash value. There's no winning aspect of having cash value. That really the only thing that you can do that's honest is buy term and invest the difference. And although the other companies may present it in a way where it sounds attractive, that's all manipulation and it's not factual. Okay? So what are some of the things that they say? Who's seen these videos before, right? What are they saying on there?
It'll pay for itself eventually. Like you won't have to pay it. You have to pay for it.
Okay, so you won't have to pay for your life insurance anymore. What else, Sheila? Have you seen? You weren't here. We're talking about how, like, on TikTok, on social media, everyone's promoting this stuff now. So what did you hear?
So most of the time, it will tell you that whatever the death benefit is, no matter what, you will get that. So let's say somebody applied for $500,000, they will tell them that even if you live too long, you will still get $500,000, whether you live or you die. Either you get it or your family gets it if you die. But we all know, like, we've read hundreds of policies from different companies, and it's all a lie.
Yeah. So
But
that part's a lie.
They are banking on the fact that people are ignorant, right?
Yeah.
Most people are ignorant.
People are, yeah. Not in a demeaning way, but
No,
they're
no,
just
but-
uneducated. What do you hear, Smallville?
Infinite banking, it's like a money glitch that you can get getting money out, and even if you get the money out, like the company's paying interest on your money, so you make
Yeah. So we talked about this before. People say if you take $50,000 and you put it into a policy, and then you take it out. And this is what I think the rapper said too, and some of the other people, they're like, yeah, now I'm getting the money out and it's tax free. Well, last time I checked, if I take 70 grand and put it in my checking account and then I take it out, also tax free. Right? So that part I don't understand. Like, wait a second. Why would I borrow money from the bank when I could put my own money in, right? And then take it out? It's like, if you had 70 grand in the first place, you wouldn't be worried about borrowing the money. You know what I mean? So,
Right.
and the other thing that people don't understand is that if you front end load a life insurance policy, insurance companies aren't dumb. If you take 50, 70 grand and you put it in, that money is not immediately accessible, Ann, right? You can't just take 70, write it to a life insurance company, and then the next day say, I'm buying a piece of real estate, I'm gonna go in and borrow that 70. Everybody knows that a good portion of that is stuck in there based, they have a surrender schedule, which means that it costs money for you to be able to take that money out at the rate of 50 to 60% of a fee in that first year, if at all. I've seen people front end load into policies. I've met people who rolled over their entire 401k, $100,000 into a life insurance policy, and none of it is available the first 2 years. So show me this example where you can put money in and then immediately take it out. So it is literally a lie. There is absolutely no truth. And when you're talking about this much money and this much commission, people get really creative in terms of wanting to make something sound attractive. I'm telling you right now, it is all a lie. This is not how policies function. And one of the ways that they do it is they'll say, this is what the wealthy do. This is what they do and that do, right? That's not the case. In very few scenarios are wealthy people doing something like this. And in the instances where they are, maybe they're trying to hide a bunch of assets or whatever, and there's probably a better place where they can potentially do that.
Yeah, I just saw a video yesterday somebody sent to me, and the guy was saying, oh, if you want to take equity out your house, it's the same thing as your life insurance policy for infinite banking, but with a mortgage and equity, you have to qualify for it, and if you just loan your own money, you don't have to qualify.
Yeah, but the question is, like, how did the money get into the life insurance? You can't buy a $500,000 policy and start borrowing against it. You had to put money in, right? So if I put this much money in, I now have access to this much money, but I still had to put in this much. It's not that I put in this much, I have access to this much, or I put in this much, and then I have access to this much. If you bought a home in the last year, right, you can access more money a year later than what you put in because it actually appreciated because it's an actual market, right? It doesn't work like that in life insurance. You always have less than what you put in unless you're willing to wait 20, 30 years, which at some point, sometimes some policies, the cash value will exceed what you put in after 20 years. But again, I don't think all these people on the internet are wanting to wait 20 years for something, right? Go ahead.
I know a lot of people that want to do what? They want to mirror the wealthy people. In what instance do the wealthy people get a whole life? Because I guess because they market that whole life is for wealthy people, right? And the term is for less.
What I've read in terms of why a mega wealthy person will put the money into whole life, and I'm not saying that this is true. This is what I've heard, and I'm not interested enough to, because I don't run into that situation enough. All the wealthy people that I know, none of them are doing this. So it's almost anecdotal. What that means is like, it's a personal thing. Maybe you heard it from someone, but I don't really know if people are doing that. That being said, what I've read is that if someone front end loads a whole life policy with $1 million, because it's in life insurance, maybe potentially can't be looked at as an asset if they get sued or if they go bankrupt, right? It's maybe a place where they can hide money. That's the only thing I've heard, and I don't know if that's true. And it doesn't pertain to 99.9% of the situations that we are encountering.
I want to go off what Sheila said. So when you're saying that they're not guaranteed face value, like what determines, like, can you just kind of, so I encountered somebody who had $1 million policy. I just, how.
First of all, the person you encountered doesn't have $1 million, they lie. Based on the message that I heard,
yeah,
very few people have $1 million whole life, and I don't think that they did. Okay, $1 million whole life is no joke. When you're 25 years old, a $500,000 whole life is 500, which means that $1 million whole life is over 1,000. And that's at 25. How old is this person? 36. Okay, that's a very expensive policy, and I don't believe off the bat that they're paying $1,500, $1,600 a month for their life insurance, right? What Sheila is saying is that they are claiming that whether you live or you die, in both scenarios, your family is going to get that face value. If you die, yes, and you were paying on it, it's a life insurance company. They are going to give you that 500 to $1 million. If you live, no, that's not the case, right? In a whole life policy, they are designed so the cash value can, in a straight whole life policy, it can equal the face amount when you turn 100. Okay, so you'd have to wait 100 years for your cash value to equal your face amount, right? And although to some that may sound good, like, hey, after when I turn 100, I can actually have $1 million of cash value. The question is, if I had taken that same amount of money, could I have had $1 million at the age of 55 or 60? Why wait till I'm 100 years old? Okay, so the math doesn't work in their favor if you are paying attention to the numbers and you understand numbers and calculations and things like that, right? So let's go through a few of these. Thomas, you got me on the right? All right. So let's go through some basic stuff, ways to kill cash value. So this is a classic presentation that I don't think a lot of people are using, and you should be using it. This is how I learned to overcome cash value. And it's called Banks and Fridges. And it's probably a 30-year-old presentation, which is why it says Sears on it. So we'll change that to Amazon. You remember Sears? You've never heard of
That's funny.
Right?
Funny.
I
That's
didn't know how to
terrible.
change the graphic because it's all one, right? So I didn't know how to change it. Josh is explaining it's a score. So this is how, let's talk about banks and fridges, right? And so this is how we used to explain it, is that imagine if you bought a fridge and it's the exact same fridge, exact same model, exact same features, but one you bought from, I'm just going to say Amazon, and then one you bought from Best Buy. Okay, they're the exact same fridge. Amazon is charging you $2,000 for the fridge. Best Buy is charging you $1,000 for the fridge. So which fridge are you going to buy? It's the same fridge. Not a trick question. You're gonna buy 1,000, right? Why would you pay more? You're gonna buy the 1,000, same fridge. But here's the thing: the Sears fridge, the Amazon fridge has a special warranty, right? Has a special warranty where after 20 years, because they know that they charge you more, after 20 years, they will give you your $2,000 back. Whereas the Best Buy fridge, after 20 years, you get absolutely nothing. So now, Rod, which fridge are you going to buy?
The Sears.
The Sears,
I wouldn't do that.
right? Because we want our money back. But Mr. and Mrs. Client, have you ever heard of the Rule of 72? The Rule of 72, and usually I show them that slide. The Rule of 72 says what? If I take the number 72 and divide it by my investment rate of return, that will give me the number of years it will take to double my money. Okay? Lynn, have you ever heard of this? Okay. So if I am getting a 1% return on my money in the bank, I take the number 72, I divide it by 1, that equals 72. It would take 72 years for me to double my money. If I'm getting a 3% return, 72 divided by 3 is 24. My money takes every 24 years to double my money. So if I had 1,000 in the bank, after 24 years, it will go to 2,000. After 24 years, it will go to 4,000. Now, let me ask you, okay, what is, like, investment guy, right? You want to get an investment license out. What do you think the average rate of return is? Just average on let's say your 401k over time.
Like if it's general, like 8%.
Okay. So even with the market downturn right now, the 10-year average, I think, is around 12%. That's with the market being down almost 30% this year. Okay. So should the market have been at 18% a year like it was at the beginning of the year? That's probably a little much. Now the market has deflated. Even with the recent downturn, we're still averaging 12%. Okay. But we'll take his and we will say, even more conservative, a 7% return. So Mr. and Mrs. Klein, you're in agreement that in your 401k, you can get at least 7%. Well, if you take the number 72 and you divide it by 7, what you're telling me is that your money will double every 10 years. So part of this is being able to explain rule of 72. You got to get a little good at that, but we have a slide where you can just read through it. You don't have to explain it the way I do. So imagine this. What if we buy the cheaper refrigerator from Best Buy, and then because we're saving $1,000, we take that $1,000 and we invest it, let's say in your 401k or in any investment. Now, what did we say? How often would the money double? Every 10 years. So in 10 years, your money will go to 2,000. Remember, you're waiting 20 years to get your money back. At the second 10-year period, your money went from 2,000 to 4,000. So if you bought the cheaper refrigerator and then invested the difference somewhere else, you would actually have double the money at the end of the 20-year period. So now which refrigerator would you buy? You'd buy the one from Best Buy. And Mr. and Mrs. Client, that is how life insurance works and cash value works and whole life works. All they're doing is they are overcharging you on the front end. They keep all the interest. They give you back what you put in. But if you are willing to buy the cheaper policy, which in this case is term insurance, and you let us help you invest the difference, now you can see you're going to have a lot more money in the future. So nobody, and this is the transition, nobody buys whole life insurance for the cost. You buy it because of the investment that's inside it. And then that's how we go to banks. Imagine if there's two banks, Bank A and Bank B. Bank B has a high rate of return. Bank A has a low rate of return. So, Ann, which bank are you going to bank with? B, you want a high rate of return on your money. No one wants to intentionally put their money into something where they get a low rate of return if a high rate of return is available. Bank B, if you want your money, right, you just take it out. That's called being liquid. But if you want your money from Bank A, you have to borrow it, which means that eventually it has to be paid back. Imagine going to the teller line and you don't make a withdrawal, you have to get a loan for your very own money. Does that sound good? No. So which bank are you going to bank with? Bank B, right? And with Bank A, there are, if you die, it's complicated. There's a lot of paperwork. So what they're simply going to do is keep all of your money if you die. It's just easier for them. So whatever amount of money you have, you die, they're just going to keep it. Whereas Bank B, there's survivorship. You can give the money to your family. Which bank are you going to bank with? B, right? Well, you just chose Bank B, but Bank A is how cash value works inside of a whole life or cash value policy, right? That is how it works. You get a very, very low rate of return or a capped rate of return in the case of universal life. If you want the money, there's no withdrawal. You have to borrow it. And if you die, they keep it. Now, imagine this. And if you are already here, is there anything I could say to get you into this situation here? Would you ever go, if you were already in Bank B, would you ever go into Bank A voluntarily? You'd never do that. So the banks and fridges, and by the way, I have not done this presentation in 10 years. But you saw how I did it, right? And I did not practice before I came up here. Because I did it so many times, it's basically, it's ingrained in me. That's how many times you got to do it. That's how many times you got to present it. And what it kills, right, is getting the money back. It kills that because it's like you're going to get more money back if you invest the difference. And the rate of return you gave, that's the rate of return you told me. A lot of times the mistake you guys make is like, yeah, the market does 12%. You don't know if they believe that. You got to ask them what they think the market does. And everyone's like, oh, market's down right now. Yeah, but with the down, it's still 12%. So you got to know those numbers too, right? Or I'm telling you. So
do you let them answer incorrectly and then you correct them? Or like, so if they say like, if they're they say like the market's down and they're like, well, it's low, it's really low right now. Do you then go, it averages out to be about 12?
yeah, if I have to correct them, I correct them. I think most people, like, they do know that, but another agent would be like, the reason you're getting into this situation here is because the market is underperforming, so why not be in a safe situation, where your money doesn't fluctuate? This is a different conversation. But, even with the market fluctuations, we're still at a double-digit rate of return. Who has questions about banks and fridges? I love this one. It's a classic one. It works. I have better ways now because I show them real policies, which I'm going to show you right now. Plus, I can just communicate things better, right? I can be very illustrative just with my words, right? I have that skill. You'll acquire that skill as well. But in the beginning, when you're new, you want to use these visuals because it's going to help you convey the message properly. Does that make sense? So I'm not asking you to sound like me. I'm saying use the freaking slides and just talk about them, and promise you a light bulb will go off. People see me now. Remember, I started at 22 years old with no experience, and I was sitting down with very qualified people. I was raised in Northern Virginia. My clients are in Northern Virginia. This is the wealthiest, most educated market, right? This is how Shaq and I built this business. That's why we're so professional. We're not in Texas. We're not in North Carolina, right? We're not in Kentucky. We're not in Tennessee, right? This isn't the type of place where everybody knows their neighbor and you can just knock on a door and people just let you in. This is not that. This is a very different environment. And when I hire people, I let them know, like, don't worry about it. You're working with the most professional people because we understand the Northern Virginia market. And if you're listening on Zoom and you're not in Northern Virginia, the advantage that you have is if you can learn how to communicate the way that we communicate, you will kill it in your market. My friends that move to Florida that make millions of dollars a year, they're like, Samir, you don't understand. If you talk the way you talk in Northern Virginia, in Florida, it's like game over because the professionalism that we have. How about the videos? I cannot believe people aren't using the videos. Unbelievable. You get out of an appointment, someone's giving you a hard time. Do you show the video? No, listen. You got to use the higher authority. Number one, if someone has the video with views, we know the world today, they're like God, right?
Yeah.
It's like they have views, and we have to listen to those people. So people, when they see that, they pay attention. And then when you have recognizable faces for some people, right? For people probably 30 and up, maybe, you have Dave Ramsey, Susie Orman. But what I like about the video is that they say it in a tone that we're not allowed to talk in. They'll say, your agent, if your friend is an agent, they're ripping you off. You shouldn't be friends with them anymore. This is trash. That company's taking advantage of.
Yeah.
We can't talk like that to people, right? We shouldn't be. And so we let them do the talking for us. So are you able to play the video that I sent to you?
That's Dave Ramsey.
Ray is on Facebook. Why term life insurance instead of whole life insurance? What's the difference? Term life insurance is just insurance. That's all it is. It's like your car insurance. That's all you get. You don't get any money unless you die. And so you don't ever get any money. It goes to your beneficiary, right? The only way it pays off is when you die. The way your car insurance pays off, you don't make money on your car insurance, your homeowner's insurance. That's pure insurance. That's all it does. It doesn't have any gimmicks or bells or whistles that has an investment built into it. Or you can buy cash value life insurance, which includes whole life or universal life or variable life. Now, here's the typical numbers. Okay. Typical numbers are for $5, you can buy as much term life insurance on a 20-year level term as you can for $100 buying cash value life insurance per month. So why would you pay $95 more per month? Because it builds